In 1934, a Kansas wheat farmer named Earl Dunstan paid $11 in federal taxes on a family income of $800 and did it himself at the kitchen table with a 2-page form and a pencil. Today, the average American pays $270 to have someone else fill out a form that has not gotten simpler, only more profitable for the industry that complicated it. Number 14 on this list is a legal practice the IRS published guides for until 1962. Number 3 kept farm families solvent through the Depression without a single bank loan. Hit subscribe, because what your great-grandfather knew about money is what the financial services industry spent decades teaching you to forget. Let us count them down. Number 25. The barter ledger. Your great-grandfather tracked every trade in a 15-cent ledger book. A day of labor for a bushel of wheat, a pound of butter for a haircut. He recorded the fair market value of each exchange in pencil and kept the book in the kitchen drawer. The IRS has required barter income reporting since 1933, but accurate personal record-keeping kept families compliant without a single accountant. H&R Block opened in 1955 and began charging $18 to do what the ledger had always done for free. The IRS's own 1934 Taxpayer Bulletin stated that personal record-keeping was the foundation of every correct return. The ledger still works. The accountant just costs more. Number 24. The kitchen garden as household production. Your great-grandmother's garden was the family's primary food production unit, and under Depression-era tax law, food produced and consumed at home was not taxable income. A quarter-acre garden produced an estimated $600 worth of food in today's value annually, none of which appeared on a tax form. The USDA encouraged home gardens throughout the 1930s precisely because home production reduced taxable cash transactions. By 1970, suburban zoning had converted non-taxable home production into taxable wage income spent at a grocery store. The garden is still legal. The food it grows is still not income. Number 23. The community lending circle. When a family needed capital and the bank was unwilling, your great-grandmother's neighborhood ran a rotating savings circle. 10 families each contributed $5 monthly. Every month, one family received the $50 pot. No interest, no fees, no bank. The IRS did not tax the pot because it was a return of contributed principal, not income. A 2018 Federal Reserve study confirmed rotating savings associations remain fully legal and among the most effective wealth-building tools available to low-income households. By 1960, consumer credit had replaced the lending circle. The credit card company charged 18% on money the circle gave for free. Number 22. The cash payment record. Your great-grandfather paid for everything business-related in cash and kept every receipt in a cigar box on the workbench. When tax time came, he emptied the box, totaled the receipts, and subtracted legitimate expenses from income before calculating what he owed. The IRS has allowed business expense deduction since the Revenue Act of 1913. A cigar box cost nothing. The receipts cost nothing. By 1980, the tax preparation industry had convinced most Americans that identifying deductible expenses required professional help. It did not then. It does not now. The cigar box was the system. Number 21. The farm depreciation record. When your great-grandfather bought equipment, a plow, a harrow, or a wagon, he recorded the purchase price, estimated the useful life, and divided the cost across those years in his ledger. The IRS has allowed asset depreciation as a deduction since 1913 and published clear instructions in its annual taxpayer bulletins through the 1950s. By 1965, accounting firms had reframed depreciation as requiring professional assistance. The formula is division. Cost divided by years of useful life equals annual deduction. That formula has not changed in a century. Number 20. The home office record. When your great-grandfather ran any part of his business from the farmhouse, he measured the room used for business, divided it by the total house square footage, and deducted that percentage of heating, lighting, and maintenance as a business expense. The IRS published this proportional use method in its 1938 Small Business Guide. By 1990, TurboTax had built an entire interview sequence around the home office deduction, implying complexity. The calculation is division. Room square footage divided by total square footage. A number your great-grandfather got in 30 seconds with a pencil. Number 19. The charitable contribution record. Your great-grandmother kept a notebook for charitable giving. Every church donation, every bag of clothing given to a neighbor, every bushel of produce for the food drive went in with a date and fair market value. The IRS has allowed charitable deduction since 1917. The notebook was the documentation. By 1985, tax software had surrounded the charitable deduction with enough warning language that most Americans stopped claiming it entirely. The notebook cost a nickel. The deduction was legal and required nothing but the written record she kept anyway. Number 18. The family labor record. When your great-grandfather's children worked the farm, he recorded their hours and paid a reasonable wage deductible as a farm business expense. The children paid little or no tax because their earnings fell below the taxable threshold. The IRS has allowed family member wages as a legitimate business deduction since 1918, provided the work is real and the wage reasonable. A 1942 IRS Bulletin for Farm Families described and recommended this practice explicitly. By 1975, payroll documentation requirements had led most small farm families to abandon it. The tax saving was real. The paperwork was a ledger page. Number 17. The medical expense deduction record. Your great-grandmother recorded every medical expense in the household ledger. The IRS has allowed medical expense deduction since 1942 for costs exceeding a threshold percentage of adjusted gross income. She needed the total of her medical expenses and her income. The division told her whether she qualified. Jackson Hewitt now charges a preparation fee, partly justified by the complexity of this deduction. The complexity is one subtraction and one division. Your great-grandmother did both at the kitchen table without assistance. Number 16. The casualty loss record. When a storm damaged the barn, your great-grandfather documented the loss with a written description, a date, and a fair market value estimate. The IRS has allowed casualty loss deduction since 1913 for uninsured losses. He filed the loss and reduced his taxable income by the uncompensated amount. A 1936 IRS bulletin described casualty loss documentation in 2 paragraphs. By 1980, most Americans believed the deduction required an appraiser and an accountant. It required a pencil and an honest estimate. That is what your great-grandfather provided. Here is where things get interesting. The Depression-era American household was a complete financial entity that produced income, managed expenses, documented transactions, and filed its own taxes without paying anyone to help. The kitchen garden produced non-taxable food. The barter ledger documented trades. The cigar box held deductible receipts. The household ran its own accounting department on 15 cents of paper and a pencil. H&R Block opened in 1955 and charged $18 to do what the ledger had always done. By 1985, the company had 4,000 offices nationwide. Intuit launched TurboTax in 1984 and convinced most households that tax preparation was a product to be purchased rather than a skill to be held. The IRS has published free filing guidance since 1913. The information was never hidden. The industry simply made the alternative feel impossible. Number 15. The self-employment tax record. When your great-grandfather earned income outside formal employment, he recorded every dollar in the farm ledger and reported it on his return. The deductions available against self-employment income, equipment, supplies, travel, home office, and family wages reduced the taxable portion significantly. The IRS published a plain-language self-employment guide annually through the 1950s. By 1990, H&R Block had built its self-employment filing package into one of its most profitable product tiers. The arithmetic has not changed. Income minus legitimate expenses equals taxable income. H&R Block charges $320 to calculate it today. Number 14. The installment sale record. When your great-grandfather sold land to a neighbor over several years, he reported only the portion received each year as income rather than the full price in the year of sale. The IRS has allowed installment sale reporting since the Revenue Act of 1926 and published clear instructions in annual taxpayer bulletins. Spreading income across years kept each year's bill manageable without professional help. By 1970, the installment sale had been reframed as requiring legal and accounting assistance. The calculation is the percentage of the total price received each year multiplied by the total gain. Your great-grandfather did it in the farm ledger. Number 13. The crop insurance deduction. When drought damaged a harvest, your great-grandfather deducted crop insurance premiums as a farm business expense and reported insurance proceeds separately as income in the year received. The IRS allowed farmers to defer insurance proceeds to the following tax year if the crop would normally have been sold then. A 1939 USTA bulletin described both practices plainly. By 1980, agricultural tax specialists had built entire practices around farm tax complexity. The deferral election is one checkbox on one form. Your great-grandfather checked it himself. Number 12. The timber sale record. When your great-grandfather sold timber from the farm woodlot, he reported proceeds as a capital gain rather than ordinary income because timber held over a year qualifies for capital gains treatment under rules existing since 1944. Capital gains rates have been lower than ordinary income rates in every decade since 1922. The IRS published the distinction clearly in its farm tax bulletins. By 1975, most farm families had been convinced the distinction required a tax professional. It required knowing which line to use on the form. Number 11. The fuel tax credit record. Your great-grandfather used gasoline to run farm equipment that never touched a public road. The IRS has allowed a credit for off-road fuel use since 1932 on the grounds that farm equipment users should not pay a road tax for roads they do not use. He kept a simple fuel log, calculated the gallons, and claimed the credit on his return. By 1985, the fuel tax credit had become one of the most commonly missed credits among self-employed filers according to IRS compliance data, not because it disappeared, but because the industry never mentioned it. Number 10. The home-based business inventory record. When your great-grandmother sold eggs, butter, or preserves from the farmhouse, she kept a running inventory in the kitchen ledger. Cost of goods sold was deductible against the income the sales generated. The IRS has allowed this deduction since 1913. She recorded what she spent to produce what she sold and subtracted one from the other. By 1995, home-based business tax treatment had been surrounded by enough professional caution that most small sellers simply did not deduct. The arithmetic is subtraction. Your great-grandmother did it in pencil. Number 9. The energy improvement record. When your great-grandfather insulated the farmhouse or installed a more efficient stove, he documented the improvement with a date and cost in the farm ledger. Recording every physical improvement established the cost basis that reduced taxable gain when the property was eventually sold. Federal tax incentives for home energy improvement have existed since the Energy Tax Act of 1978, but the documentation habit predated them by decades. By 2000, cost basis tracking had been reframed as a complex accounting function. It is a column in a ledger with a date and a dollar amount. Here is where the financial services industry gets uncomfortable. Between 1999 and 2022, Intuit spent $36 million lobbying Congress to prevent the IRS from offering free direct filing software. ProPublica documented the campaign in a 2019 investigation. Internal documents ProPublica obtained showed Intuit's private argument was that free government filing would destroy the paid preparation market. H&R Block and Jackson Hewitt joined the effort. The three companies together represented an industry generating $14 billion annually from a task the IRS had published free instructions for since 1913. The IRS Free File program, launched in 2003, was structured to hide it from most search engines at the industry's request, confirmed by a 2019 Senate Finance Committee investigation. Your great-great-grandfather paid $11 in taxes and prepared his own return in an hour. The industry replacing him generates $14 billion a year. Step back from the lobbying budgets and the software packages and look at what was actually being defended. Your great-grandfather's kitchen table was the family's financial headquarters. The ledger sat in the drawer. The cigar box held the receipts. The household knew what it earned, what it owed, and what it could deduct without paying anyone. That arrangement was the single biggest obstacle to the financial services industry being built around it. A household that keeps its own ledger does not need H&R Block. The tasks did not become more complex because complexity was necessary. They became more complex because dependency was more profitable than simplicity. Number 8. The estate planning letter. Your great-grandmother wrote a plain letter describing how she wanted her property distributed, had two neighbors witness it, and kept it with the deed. The letter established clear intent that reduced family conflict and simplified the eventual legal process. Estate attorneys now charge $1,500 to produce a document beginning with the same information. The letter cost nothing. Number 7. The property tax appeal. When your great-grandfather believed the county had overassessed his farm, he appeared before the assessor's board with comparable sales evidence and argued for a lower assessment himself. Property tax appeals are a legal right in every state, requiring no attorney. Property tax appeal services now charge 30% of the first year's savings. He appeared himself and kept the full saving. Number 6. The disability and loss documentation file. When illness or loss reduced the family's ability to earn, your great-grandmother documented everything in the household ledger. Medical costs, lost production, damaged property. The documentation supported every available deduction the tax code offered for hardship. She did not know every provision by name. She knew a complete record was the foundation of every legitimate claim, and she kept one. Number 5. The rental income and expense record. When your great-grandfather rented a field or equipment to a neighbor, he recorded rental income and every associated expense in the farm ledger. Rental expenses are deductible against rental income under rules existing since 1913. A 1947 IRS bulletin described the record-keeping in 2 pages. By 1995, most small landlords either over-reported or under-deducted. The arithmetic is income minus expenses. Your great-grandfather did it in pencil. Number 4. The family gift and loan record. When your great-grandmother lent money to a sibling, she wrote a simple note with the amount, date, and whether it was a loan or a gift. The IRS has set annual gift tax exclusion limits since 1932 below which gifts require no reporting. Loans documented as loans are not income to the recipient. The note prevented the IRS from reclassifying either transaction. Estate attorneys now charge hourly to produce what your great-grandmother wrote on note paper. Number 3. The farm loss carry-forward record. When a bad year produced more expenses than income, your great-grandfather recorded the net loss and carried it forward as a deduction against future profitable years. The IRS has allowed business loss carry forward since the Revenue Act of 1918. The documented loss reduced the tax bill in the next profitable year. By 1980, carry-forwards had been reframed as requiring professional guidance. The calculation is this year's loss subtracted from next year's income. Your great-grandfather did it in pencil. Number 2. The personal exemption record. Your great-grandmother counted every dependent and claimed every personal exemption the tax code allowed because the IRS published the qualifying list clearly, and each exemption reduced taxable income. In 1934, a family of 6 reduced taxable income meaningfully through exemptions alone before any deduction was calculated. She did not need a professional to count her children. She needed the free IRS bulletin. It was free. The counting required no software. And number 1. The household as its own financial entity. The most powerful trick your great-grandmother knew was not any single practice. It was the understanding that the household itself was a complete financial unit, earning, producing, deducting, documenting, and filing without paying anyone to stand between it and the system. The ledger was the accounting department. The cigar box was the filing system. The kitchen table was the office. Total annual cost, 15 cents and a pencil. The financial services industry now extracts $313 billion annually from American households according to a 2022 Consumer Financial Protection Bureau report for services your great-grandmother performed herself at no cost. Here is my challenge. Start a ledger this week. Write down income and expenses. Keep receipts in a box. Look up IRS Free File at irs.gov before paying anyone to prepare your return. I filed my own return last year using free IRS tools and paid nothing for preparation. Tell me in the comments which practice you are starting with. I want to know if the barter ledger gets more love than the kitchen garden record, because these were not loopholes. They were the standard financial competence of every American adult before an industry decided that competence was worth more to them as a product. Your great-grandmother knew. Now you know too.